Hey guys, how's it going? Just a quick reminder, if you're not in the Discord server already, you have just about 1 week left before we go paid only, members only on September 1st. So make sure you get in there now if you want to check it out. Hey guys, how's it going? Solo back at it with another daily update video and taking a look at the big board today. Kind of thought this is what was going to happen. A lot of greed on the board, and that's because if you missed it, but yesterday evening, the president had a press conference where basically another vaccine pump. It wasn't really a vaccine, but again, he was out there pumping the market, and I figured we would gap up and open green today, and looks like we did. Big tech, not that impressive. I mean, they were green, but less than a percent or so for Google, Microsoft, and Amazon. Facebook, Apple, just a little bit over percent. AMD actually had a surprisingly red day today because the other semiconductor stocks had a green day. I mean, even Micron was up 2.6%. So the real question is, what's Micron going to do tomorrow? Because does that mean that $42-ish where we closed Friday was at the bottom, and now are we in store for a rally back up? Really curious to see what Micron does tomorrow. I did take a look at the options premiums this morning. Premiums on Micron, again, weren't very good. And also, I mean, we'll take a look at it in a second, but I thought, okay, AMD is red, might be a great day to sell some cash secured puts on AMD. But the premiums on AMD were actually pretty bad, if I have to say so myself. I mean, I think the at-the-money return on risk was about 1.8% today when I calculated it, which was actually rather low. Nvidia was pretty much flat, Intel pretty much flat. So overall, green day in the market, and I did something today that I thought I would never do. If you're in the Discord server, you already know what I did. If you're not in there already, make sure you get in there to get kind of real-time market news, and we just chat all day long when the market is open. So a lot of good information in there, a lot of friendly, helpful commentary in there as well. So make sure you get in there if you're not. But for those of you that don't know, I played a ticker today that I thought I would never play. And stick around towards the end of the video and I'll let you know what that was. But let's just get at it and talk about some of the tickers that I like to always look at, and that's AMD, like I mentioned before. So, AMD opened up green, about 1.4%, sold off, and then traded flat all day long. So this normally would have been a good time to get in on some AMD puts if you were interested, because it was a red day, even when the rest of the market was green, which was a little bit surprising. But let's just take a look at the options chain. So selling a put on AMD, the at-the-money value was $162 in premium, and the return on risk would have been 1.9% or almost 2%, which is not great. I mean, usually AMD is around 2.5 or more, I feel like. So I'm not sure why the premiums on AMD weren't that juicy today, but really wasn't appetizing for me in terms of opening up a put. So I actually did not open up any puts today. And so now you might be asking yourself, well, he said he played a ticker today. If he didn't open any puts, what did he do? That's not completely true. I did not open any cash secured puts, is probably a more accurate statement. So let's just take a quick look at Micron as well. So Micron, again, nice green day today, up, like I said, almost 2.5% or a little bit more. So if you wanted to sell a put on Micron, $60 in premium at the money, divided by 43.50 in collateral, and the at the money return on risk is only 1.4%, so even worse than AMD. That's what I mean. The premiums on Micron just have not been really juicy the past few days, maybe about a week or two, ever since I've been looking, since it's been dipping. But let's take a look at some of the stocks I mentioned on my stream from last night, taking a look at SPY, and we'll get back to SPY in a second. But let's take a look at Salesforce here, CRM. So they were actually up 0.5%. They have earnings coming up soon if you missed my weekend video from last night. Dollar General was actually down a little bit. I mean, pretty much flat, down 0.3%. Best Buy had a nice little pump today, up 3%. So curious to see if any of my viewers got into Best Buy. I think of all the tickers I mentioned in my video from yesterday, Best Buy probably got the most action, just because I'm assuming most people are most familiar with Best Buy compared to some of the other tickers. Toll Brothers, the kind of real estate or housing company, I believe, they were up 2.3%. Box was actually up 0.6%. I was also taking a look at SMH this weekend because they did have a little bit of a sell-off the past couple of days, so I thought maybe a good point to get in. They actually rallied a little bit at 0.9%. The thing with SMH though, because it's the semiconductor ETF, it really does not have good premiums. In general, a lot of the ETFs, just because they're essentially safer tickers, they don't have a lot of juicy premiums because basically premiums are a reflection of many things, but I just like to think of it as kind of your risk. The more juicy a premium is, the reason is because the risk is a little bit higher. So, high risk, high reward, low risk, low reward. So because these ETFs like SPY and SMH are lower risk, it makes sense that they have lower premiums. So let's just say at the money, it'd be $181 divided by 17,250 in collateral. So that will be a return on risk of about 1%. So it's less juicy than any of the tickers that we already looked at, Micron and AMD, which are actually in this semiconductor sector. So it's not that risky. I mean, if we zoom out and look at this graph, it's actually been pretty taking off. I mean, it's been hitting all-time highs every single day. This is pre-illness. It was about a high of 152. I mean, we hit that back in early June. We are only at 172 already. So we are up $20 above all-time highs pre-illness. So the semiconductor sector has just been taking off like a rocket these past few weeks and past few months. But let's just take a look at SPY, because I actually saw something interesting on SPY today. If you actually were ever interested in trading SPY, if you had the capital in your portfolio to sell a cash secured put, you'll see that, well, first of all, SPY opened up about 0.7%. And then actually during power hour, I mean, look at this, 3:10 to 4 o'clock. It went from 341.24 to 342. So it went up about $1.50 just in the matter of an hour. But because SPY is such a relatively low risk ETF, the premiums on SPY are never juicy, in my opinion. I mean, $94 in premium at the money for selling a put, divided by 34,200 in collateral that you would need just for one cash secured put. You can see the return on risk is very low. It's only 0.3%. I mean, that's actually pretty scary low. And the one thing to keep in mind, though, is that SPY has expirations 3 days a week. So most tickers, I should say, have weekly expirations. Not all tickers even have weekly expirations. They only have monthly expirations. SPY is one of the very few tickers that actually has expirations every Monday, Wednesday, and Friday, as long as there's no holidays that week. So, for example, there was actually an expiration today. Again, Robinhood doesn't allow you to trade 0 data expiration options, so that won't show up. But as you can see, the next expiration is actually on Wednesday. So that's August 26th. So this is a 0.3% return on risk, but it's not a full weekly option. It's for this coming Wednesday. If you wanted to trade kind of the equivalent of weekly, that would be August 28th. So we can calculate the return on risk for that option. So that would be $169 divided by, again, 34,200 in collateral. So the return on risk for essentially a SPY weekly is 0.5%. So it's a little bit better. Obviously that makes sense because there's more time to expiration, but it's still not really that juicy. So that's why I don't really play SPY, aside from the fact that I don't have the capital to sell cash secured puts that are that worthwhile on SPY. But the one thing that caught my eye is I was looking at Robintrack. And if you're not familiar with this website, I believe it's going to be going away soon because Robinhood is no longer going to be supplying this data for free. They're going to sell it, I believe, to market makers and hedge funds, if I'm not mistaken. But this data keeps track of all the essentially transactions that happen on the Robinhood application. So I was taking a look at this graph, and this is looking at SPY, which is actually the number 63rd most popular ticker traded on Robinhood. The one interesting thing that I saw was you can see the times before the illness, meaning let's just say, the peak drop kind of happened, let's just say February 19-ish here. So if we go back to, let's just say, the beginning of the year, which would be January, which is somewhere around here, you can see the number of people holding shares on Robinhood was pretty flat, all the way dating back to, May of 2018. There's not a lot of activity or I should say not a lot of change in the number of Robinhood users holding shares of SPY. But then the interesting thing was the run up to peak illness, the number started increasing. You can see it was kind of a straight line. Now it starts going kind of exponential or maybe parabolic if you want to think about it that way. But the number increases. And then as SPY plummets, it just takes a nosedive. The number of users on Robinhood holding shares of SPY keeps going up. I mean, it even goes up at a faster rate than it did previously. So people here were essentially buying the dip. And then as SPY continued to come back up, even more people are holding shares of SPY. So you would think that if people bought the dip and then now SPY is coming back up, you would assume that the number of people holding shares of SPY would go down because now people are selling off shares for profit. But that's not happening. The number of people owning shares of SPY keeps going up. So you wonder, some of these people up here, is this all FOMO? Is this all people that have felt like they missed out on the run up on SPY and are now trying to get in on the action? Because the only reason to buy shares of SPY now would be if you think that SPY is going to keep going up. Because if you think that the economy is going to go down, well then you essentially bought high and then maybe you'll sell low, which is the opposite, the complete opposite of what you want to do. But I just found it interesting that there's this huge spike or run up in people buying shares of SPY, peak illness at the bottom, but then they continue to buy it or hold shares even as SPY goes up. So just something to think about. I just found it interesting, but let me know what your thoughts are below in the comments. So I know this is what you've all been waiting for, and that is, what ticker did I play? Well, I'll give you a hint. The CEO likes to meme a lot and he likes to send out a lot of tweets. So yes, I actually opened up 2 plays on Tesla, something that I thought I would never do because this stock actually scares me because it's so darn volatile and it's so darn expensive. But to get around that, because if you saw my video from this weekend regarding the split, you know that in order to sell a cash good put on Tesla, let's just take this value as example, $20,009.75, you would need 100 shares, and that would be $200,000, almost $201,000 in collateral, which I certainly don't have. So the way to play high value tickers like this is to sell spreads. So that's exactly what I did. And if you remember from my earlier videos, if your cash good put gets tested or becomes in the money, you now own shares of stock at that strike price. With the spread, if your share price goes below both of your strike prices for the spread, you basically just lose money. You just lose your max loss value, which is determined by the width of your spreads. So let's talk about that. So what I did was, and if you're not familiar with a spread, what a spread is when you sell a put, just like you would with a cash good put, but then at a strike price lower than what you sold your put at, you buy a put. And the width or the difference between your 2 strike prices times 100 is your max loss. So if Tesla blows past both of your strikes, you never get assigned shares of Tesla. You never have to fork up the $201,000 or whatever it may be to get assigned shares. You only lose money. So for example, what I did was this morning, Tesla was trading in the high 1900s, low 2000s. So to play it safe, what I did was I sold a put on Tesla and I wanted to be far out of the money because I wanted to play it safe. And I know Tesla's a very volatile stock. It can move a lot even in a day. So I sold a put at 1880, okay? And on Robinhood, to sell spreads, what you're gonna do is you're gonna hit this plus sign because it's gonna be a 2-leg order. There's gonna be 2 options that you put in at the same time, not just one. So I sold my put here for $2,085. So as you know, if this was just a cash good put, that would mean that I would have collected $2,085 in premium for selling this put. However, my collateral would have been $188,000. So the return on risk here is actually 1.1%. That's only if I sold a cash good put. But like I said, I sold a spread, and this is called a put credit spread because I'm selling a put and buying a put, and it's below the share price where it currently is. And hopefully it stays below the share price where it currently is. So what I did was then I had to decide which put do I want to buy below the one I just sold. So as I just said, the difference in strike prices is going to be your max loss. So for example, if I bought the 1860 put, that means now I have to pay $1,835 in premium, correct? So you can see, and Robinhood will calculate this for you, I receive $2,085, but I now have to pay $1,835. So my max profit is now the difference between these premiums. And you can see Robinhood calculates that for you. So my max credit would be $2.50 per share times 100 shares, so $250. So you're probably thinking to yourself, wow, that's pretty good, right? $250 for selling a spread. But now you have to calculate your max loss, because your max loss is going to be 1880 minus 1860. So there's a $20 gap between these strikes. So your max loss is $20 times 100, right? Because that's $20 per share, and each contract is 100 shares. So $20 times 100 is $2,000. So what this basically tells you is your max profit is $250 and your max loss is $2,000. So if you want to do a return on risk or return on capital or collateral calculation, it'll be $250 divided by $2,000. So actually the return on risk is not bad. It's actually very good. It's 12.5%, which is way more than you're going to get from any sort of cash secured put. But the risk here is much higher, right? Because the risk is now you flat out losing $2,000. If Tesla closes, because this expires August 28th, this Friday, if Tesla goes to, let's just say 1840, both of your options are now going to be in the money. And now you're just going to lose $2,000 flat. You're not going to get assigned any shares. You're just going to lose out on that money. So this is actually a very risky way, and it's actually a very easy way, if you don't play it properly, to just kind of erase your account, because you could lose money very quickly, as you can see in this example. But that's why I want to sell it far out of the money, because 1880 is currently at 2,000, so I have about $120 of gap between the share price and my strike price. Now, Tesla can easily move $100 a day. I mean, it's done it before. So I personally do not intend to hold these to expiration. I'm probably going to close them out maybe tomorrow at the end of the day, hoping that Tesla still trades flat or even goes up, because I don't want to risk holding these things till expiration, because one tweet from Elon or one SEC investigation or something could just send this stock just plummeting down. And I actually sold an 1880, 1875 credit spread. So I did not want to take a lot of risk, because right now, since these are only $5 apart, my max loss is only $500, because they're $5 apart, and my, each contract is 100 shares. So that's times 100. So that's $500 of max loss. Now you may be asking to yourself, well, what did you sell them for? So my collateral that I actually collected was $1.55 per share, or $155 in max profit. So I have a potential of max profit of $155 with only the risk of losing $500. So if I were to let this ride to expiration, and if I was lucky enough to collect max profit, that would be a 31% return on my risk, which is very good. But like I said, if Tesla closes Friday below 1875, then I just lose $500. Technically, my max loss is not going to be $500, because if I did ride it to expiration, that means I still get to keep the premiums. So my max loss would be $500 minus my total premium, which would be $155. So my max loss is essentially $345, which is not bad, right? I would collect a max profit of $155 to potentially lose $345 as my max loss. It's not bad. The only thing that scares me is that Tesla is a very volatile stock. Now, you may be looking at this and looking at this calculation saying, wow, I'm already super profitable because I sold it for $1.55 in max profit. And it's already trading for 8 cents. That's not entirely accurate, because if I open these up the bid-ask spreads are so wide that that's why this is not an accurate number, because you can set limit orders and you don't have to assume the risk, the mid price that Robinhood sends you. So you can see the bid-ask spread is between 1935 and 2235 and 1960 and 2195. It's very wide. So you can pick values anywhere in between them. So that's what I did, and that's why I was able to get a order filled at $1.55. If I look at my other platform right now, I'm actually profitable by about $90 as of the market close. So I actually have made $90, and I actually sold 2 of these credit spreads, but I didn't sell them for the same premium, because what I did was I opened up one premium at the morning, and then once I saw it was doing really well, I decided to open up another spread at the same strikes for a little bit less premium towards the end of the day. So the first spread I sold for a max profit of $155. The second spread I sold for max profit of $105. So between the 2 spreads, my max weekly profit is going to be $260, and my max loss is essentially going to be $1,000 because they're each $5 wide, so $500 times 2. I mean, again, if you think about it, my max loss is actually $1,000 minus my total premium, which is $260. So my max loss is going to be $740. But so right now, I'm actually profitable by $90 on both of those spreads combined right now. My target value was kind of going to be $100 at least. I was doing really well because Tesla was going up in the morning. So I was actually close to being like 35, maybe even 40% profitable in the morning, but then Tesla kind of sold off a little bit. I kind of told myself, once these spreads hit 50% profit, so once I collect essentially $130 or half my max profit, which hopefully will happen by end of day tomorrow, I'm going to close out these spreads. I'm going to buy them back and close them out. That way I don't have any more risk, and I can just collect hopefully $130 in maybe 2 days, hopefully. But like I said, I'm already profitable by $90 right now, so I'm looking pretty good. I'm hoping that no crazy tweet or no crazy news comes out on Tesla just sends the stock tanking overnight. I mean, the faster Tesla rises, the faster these spreads will become profitable. So if Tesla goes to 2100 tomorrow, then I'm going to assume going to be at least 50% profitable by end of day tomorrow. So I'm having my fingers crossed and hoping that happens. But that was actually the only play I made today. If you remember from my videos from last week, I actually still own 200 shares of Space or Virgin Galactic, but I was debating whether to sell covered calls on them or not. I saw that Space rallied really well today. I mean, we were up actually almost 4%, looks like, a little over 4%. So once I saw that was happening, I was hoping that if tomorrow is another green day, I can sell my covered calls at the $19 strike price for more profit, or for more premium, I should say, because right now, I was looking at selling a covered call for this Friday. And the $19, I was getting around $10 or $11 in the morning. And then since we continued to rally all day long, it went up to about $14, $15, $16 towards the end of the day. And it looks like we finished strong. So I was really hoping to have another green day tomorrow before I actually sell those covered calls and maybe get something in the 20s. And that's what I was waiting for. So I was kind of going back and forth whether I should sell covered call today or not, or wait. I decided to risk it a little bit and wait till tomorrow. Hopefully we'll have another green day. But so these Tesla spreads were actually the only positions I opened today. Hopefully they're doing well so far. Hopefully they do well tomorrow, and then I can close them out. Like I said, Tesla is way too volatile, and I'm too risk averse to try and hold them to expiration to max profit. I'd rather close them out for profit, even if it's only 50% max profit, live to fight another day, and then, who knows, maybe open up some more Tesla spreads the following week. So hope you liked that video. Let me know if you have any questions or comments in the Discord server or in the YouTube comments below. And as always, happy trading.